So I'm actually going to be investing £1,000 in one of these REITs right here in this video. So make sure you stick around for that. Here are my top 3 REITs to invest in, and in this video I'm going to give you a full explanation on why I believe that each of these REITs are a great investment. Now if you're not sure what a REIT is, make sure you check out my previous video where I fully explain what REITs are and how they work. Now if you haven't seen any of my videos before, I'm Jason. I'm Jason, and this channel is all about building wealth and increasing your net worth through online passive income streams, property and investment. Now I'm not going to tell you to subscribe, but if you do, then it might just be a wise decision. Now investing in real estate is hands down my favourite type of investment, and over the last few years I built up a property portfolio of 5 rental properties. But there is another way of getting exposure to real estate, and that is through a REIT. Now investing in REITs can give you a great return, and the good thing about them is that you can actually start with as little money as you like. So you can actually get exposure to commercial property that you would never normally get the chance of owning. I'm actually going to be investing £1,000 of my own money in one of these REITs in this video. So let's crack on with my top 3 picks. Now before investing in anything, I like to take what I call a common sense approach. And I've used this common sense approach with almost all the investments I've ever made, including these 3 REITs, which I'll show you now. So the first REIT which I'm investing in is the Impact Healthcare REIT. Now this is a favourite of mine, and it's because they're a UK-based company that have a diversified portfolio of healthcare and retirement homes. Now most of their real estate is leased by care home operators and healthcare operators, and they also pay a generous dividend of around 5.4%. Now it doesn't take a genius to realise that people are living longer and their average age expectancy is getting higher, and this is mainly due to the advancements in medicine and better understanding in dietary requirements. So it's clear to me that the demand for care homes and retirement homes is going to increase. Now I told you that I base my investments on common sense, and if you agree, please be sure to hit that thumbs up button. Now I don't just base my investments on this common sense type of approach. I also look into the health and sustainability of the company, plus a few other factors. So the Impact Healthcare REIT currently consists of 109 properties, which comprise of 106 care homes currently on 20 to 25 year leases. So at the beginning of 2019, the company introduced a progressive dividend policy under which it seeks to grow its target dividend in line with the inflation-linked rental uplifts received by the group. So this means that you can expect your dividend to increase year on year. Now the group's portfolio was recently valued at a staggering £418 million. So taking a look at the Impact Healthcare REIT's website and just doing a bit of research into the formation, how their company is run and set up, as we can see from this quote, our strategy is to identify new healthcare properties and tenants who will diversify our portfolio and deliver strong economies of scale. With efficient operations alongside a good quality of care, we look for investments that under our ownership will provide value for money to our tenants, customers and residents, while delivering attractive and stable returns to our investors for the long run. So taking all this into account, I believe this is a very viable investment, and I think it will produce pretty good returns in the long run. And with the added bonus of a possibly increased yearly dividend, this makes it even more appealing. The Simply Wall Street Analyzer has this company currently trading below fair value price, and we can also see that the price to earnings ratio is also good too, and the UK market averages much higher, so it's good to see that this trust has a decent price to earnings. And another factor which I always consider is the health of a company. So basically, I'm talking about the balance sheet. Now almost all REITs will have a healthy looking balance sheet because they have a lot of assets in the form of real estate. But we'll take a look at the Impact Healthcare's balance sheet here. Now as you can see, their assets far outweigh the liabilities, which is always a good thing. Now I currently own shares in this REIT and I'll continue to buy them throughout the year. In fact, I'm going to buy some right now so that you can see. Now I currently use Hargreaves and Lansdown as my investment broker, and I found them to be very good. Now I'm not an affiliate, I don't get commission from them, and I'm not interested in that right now. I'm just telling you because I personally use them and I found them to be very good. The only downside is the fees are quite high, and I think it's around £11.95 per share dealing. So if you're only investing small amounts, then it's probably not a wise decision to use them. HL are very trusted and they're a market leader in the UK, so they probably feel that they can justify charging these higher fees over other such platforms which, as we've seen popping up lately, have no fees at all. And I'm quite certain that because this recent upsurge in competition, that they will be forced to lower their fees in the future, and hopefully they do. Now, as I mentioned before, I feel it's really important to be transparent when talking about subjects like this. So if I'm advising a company or a REIT to invest in, then I'm going to invest in it myself using my own money. Now, I'm happy to show you this because I know that a lot of people on YouTube like to dish out advice, but they don't actually back it up by putting their own money down. So here you can see I currently have £1,061 invested in this REIT, and I'm going to invest another £1,000 right now. And my target is to invest over £20,000 in this REIT to give me a passive income of around £1,000 per year. So I'll just click on the REIT and go to Deal Now. This is where we place the investment, so we want to buy, and the quantity, 1,000 in pounds sterling, include the charges, and we'll just press place deal, and there you go, all done. Order is placed. So moving on to my second recommendation, and that is the Stag Industrial REIT. Now this company focuses solely on the US market, and it has a very diversified portfolio because it owns properties across the whole industrial sector. Now overall it has 457 properties with 91.8 million square feet of space across more than 60 markets. And whilst it also counts Amazon as its largest tenant at 2.5% of its ABR, it has a much more diversified tenant base. The next largest customer contributes 1.8% of its ABR, and its portfolio includes exposure to more than 45 different industries. They also pay a very good dividend of 4.69%. With the continued growth of e-commerce, more industrial space including warehouses is going to be needed. Now Stag offers very strong credentials and has a very bright future, and combine this with their generous dividend, it's definitely worth one investing in. Now here's an interesting fact. On Simply Wall Street, they have this company trading at almost 50% below the fair value price. Now what this means is they value the company at around $63 per share, and the actual current price of the shares are $31. So it certainly looks like a valuable investment. We can also see on this screenshot that their biggest share stakeholder is actually the Vanguard Group. We all know that the Vanguard Group is very trustworthy, and it's no coincidence why they invest in Stag REIT. So if you want exposure to US industrial real estate, then the Stag REIT could be potentially a great investment for you. So moving on to my third REIT, the PRS Real Estate Investment Trust. Now this is slightly different to your standard REITs. The PRS REIT is the UK's first quoted real estate investment trust to focus on high quality new build family homes for the private rental market. So if you want direct exposure to the UK property market, here it is. They have an estimated rental value of 29 million with another 19 million pound in the pipeline. And as you can see from this graph, the share price stands around 85 pence per share, having risen since the end of 2020. Now how much do they pay? At present, this REIT gives a return of 4.59%. Now there is some evidence that the economic downturn might encourage demand for rented accommodation. PRS reports that rental demand remains high, with over 500 reservations awaiting a move-in date. So if you want to own a piece of UK residential real estate, the PRS REIT could be a very viable investment for you. Now, although Simply Wall Street have this company overvalued in terms of the current price, an interesting thing to point out is the future growth is expected to be 32% per year. So we can expect not only rental income in the form of dividends every year, but this REIT should increase in capital appreciation as well. So the main thing to take from this company is everything looks bright for the future. Their earnings growth is above average. The forecast to grow faster than the UK market, and earnings are expected to grow significantly over the next 3 years. Their assets also far outweigh their liabilities. So as I've said throughout this video, use a bit of common sense and do a bit of research when deciding on which REIT to invest in. Now, I avoid REITs in the retail and the office sectors just because of the current climate. It's clear that high street shops are dying, and working in offices has been turned on its head due to the pandemic. And to be honest, I can see that a lot of companies will continue to allow their employees to work from home after the pandemic, because they've now realised that people can actually work from home and they can do it efficiently, and it also saves them on a ton of costs. So to me, it makes sense to avoid these two sectors, because although they did perform well in the past, I can't see that they're going to perform well in the future. And for this reason, I'm going to stick to healthcare, retirement homes and industrial REITs, as I mentioned here. I also want to mention that I'm not a financial advisor, and the information that I provided is just my personal opinion. I also want to mention that you should always diversify your... Somebody's alarm going off, wonderful. Why does that always happen? Okay, I can't sit here all day waiting for the alarm to go off, so we'll crack on. As I was saying, diversify your portfolio as much as you can. As I mentioned in my previous video about REITs, REITs can actually be affected by interest rates. So a rise in interest rates will actually see the value of most REITs fall. So also be aware of this when investing. All in all, REITs are a great way to get exposure in real estate, and they certainly shouldn't be overlooked. So if you like the 3 REIT which I've advised, please hit the like button. I'll also keep you updated on my future investments, and I'll continue to be transparent, and hopefully you've learned a thing or two from this video. Don't forget to subscribe.